Hi, Jim Gore from Thor Wealth Management. Last year was a very difficult year for corporations for the most part, and that was really reflected in the bond market. And we saw last year a record number of downgrades of corporate credit, which makes sense. They're borrowing more money, and when you borrow more money, you add it to your balance sheet, your credit worthiness goes down. And what I want to talk about historically, if you look at this chart going back to 1990, this is actually very interesting because what happened in the 1980s is we had junk bonds collapse. That was when Michael Milken was selling junk bonds for first time out there. People were buying them. And what happened was when it collapsed, the market changed and people that were buying bonds were demanding what is known as covenants, protection against the money that they would borrow, back making sure that the company was doing things, making sure their debt levels weren't getting too high, they had cash on their balance sheet, those sorts of things. But we actually started seeing those bonds with covenants get destroyed a little bit, and that actually started before 2008. Before the market corrected there. And it really accelerated after 2014. I think a lot of this has to do with the easy money of the Federal Reserve with its quantitative easing. And what we see right now is those bonds that have full covenants are at the lowest level it's ever been. And almost 80 to 85% of the bond market now is covenant light, which basically means you're lending money to corporations without anything having it protected or having some guidelines so that they can't really run the company into the ground. Well, because of that, and because we're having covenant lights, we're actually seeing some things happening with some downgrades. And if you look at this chart here, since 2010, you're actually starting to see a steady increase, which has really spiked up at the end of the year on corporate debt that is just one step above high yield junk bonds. These are triple B bonds. And you can see that the negative outlook has gone up dramatically because these corporations have borrowed a lot more money and because of what happened in the economy last year. So what does this mean? This means that someone has to be very careful right now, especially looking at what is happening in the high yield market, because if you look at the spreads, high yield market is not paying you a high enough yield. It's neither high or yield, if you really consider it, at this juncture. Then you have to be very careful in this space. Here at Thor, our credit indicators are saying, watch out. We actually reduced our BDC, and in many cases eliminated our BDC exposure in January. And on high yield, we're very short-term oriented in order to ensure that those companies can pay back their debt. Take care. And if you have any questions, as always, reach out to us at any time.